There's a hidden layer beneath America's $37 trillion debt crisis that almost nobody is talking about. While politicians debate spending cuts and economists warn about interest payments, something else is happening in the shadows. The United States government isn't just borrowing money anymore. It's quietly positioning itself with assets that most people don't even realize exist on the federal balance sheet. Right now, as we speak, the Treasury Department holds strategic reserves that could reshape how America manages its debt burden. These aren't traditional investments. These aren't stocks or bonds sitting in some government portfolio. These are digital assets and precious metals that operate outside the conventional financial system. Assets that can't be printed, can't be inflated away, and can't be controlled by foreign powers. Here's what should grab your attention. In the last 18 months, while everyone focused on inflation and interest rates, federal agencies have been accumulating positions in cryptocurrency and expanding gold reserves through mechanisms that bypass normal congressional oversight. They're not announcing these moves. They're not holding press conferences. They're executing a strategy that some analysts interpret in different ways. Bitcoin seizures from criminal enterprises now total over 200,000 coins in government wallets. That's roughly $12 billion at current prices. The Strategic Petroleum Reserve gets headlines, but there's also a Strategic Digital Reserve, a term sometimes used informally by commentators rather than an official government label, that operates in complete silence. Gold purchases through the Exchange Stabilization Fund have increased 400% since 2022. These aren't random policy decisions. This is systematic preparation for something bigger, according to certain economic commentators. The traditional story about government debt goes like this. America borrows money by issuing treasury bonds. Foreign countries and domestic institutions buy those bonds. The government pays interest annually and promises to repay the principal eventually. When debt gets too high, you either cut spending, raise taxes, or print more money to inflate the debt away. That's the textbook explanation. But that textbook is missing entire chapters about how modern governments actually manage sovereign debt in the digital age. The real strategy involves assets that exist outside the traditional banking system, assets that hold value regardless of whether the dollar strengthens or weakens, assets that can be mobilized instantly without congressional approval or Federal Reserve intervention in theoretical scenarios described by some experts. Let me show you how this actually works in practice. When the FBI seizes cryptocurrency from ransomware attacks or dark web operations, those digital assets don't get destroyed. They go into government wallets controlled by the Treasury. When the DEA confiscates Bitcoin from drug cartels, same destination. When the IRS recovers cryptocurrency from tax evaders, it joins the growing federal stockpile. Most people think these seizures are just law enforcement actions. They're not wrong, but they're missing the bigger picture. Every Bitcoin that gets confiscated becomes part of America's strategic reserve, in terms of the total assets held, not as part of any officially stated policy. Every Ethereum wallet that gets seized adds to the government's position in digital assets. This isn't accidental, it's policy. The numbers are staggering when you add them up. Over the last 5 years, federal agencies have accumulated cryptocurrency worth more than the GDP of most countries. And unlike traditional treasury holdings, these assets appreciate independently of government policy. When Bitcoin doubles in value, America's strategic position doubles without issuing a single new bond or raising a dollar in taxes. Gold operates through different mechanisms, but serves the same strategic purpose. The Exchange Stabilization Fund, created in 1934, gives the Treasury Secretary extraordinary authority to intervene in currency markets. Most Americans have never heard of this fund. It operates with minimal oversight and can buy or sell gold, foreign currencies, and other assets to stabilize the dollar. Since 2022, ESF gold purchases have accelerated dramatically, not through the normal channels that get reported in financial media, through swap agreements with allied central banks, through private market transactions that don't appear in official statistics, through mechanisms that keep the purchases quiet until long after they've been executed according to expert interpretations of publicly available data. Why gold? Why now? Because gold holds value when currencies collapse. Because it can't be created by government decree. Because it provides insurance against the exact scenario that America's debt trajectory is creating. When interest payments on $37 trillion become unsustainable, when foreign buyers stop purchasing treasury bonds, when the dollar's reserve currency status erodes, gold becomes the ultimate backstop in the view of many economists. But here's where it gets really interesting. The government isn't just accumulating these assets randomly. They're being positioned strategically for maximum impact when traditional debt management tools stop working, according to some financial analysts. Cryptocurrency can be liquidated instantly on global markets. Gold can be mobilized to defend the dollar or used as collateral for emergency lending. Both assets exist outside the control of foreign governments or international institutions. This creates optionality that previous generations of policymakers never had. When countries like China or Russia threaten to dump treasury bonds, America can respond by liquidating Bitcoin positions that crash cryptocurrency markets, where those same countries hold significant positions in hypothetical economic models, not in documented government plans. When inflation threatens to spiral out of control, gold reserves can be deployed to signal monetary stability without actually changing interest rates. The timing isn't coincidental. These accumulations began accelerating precisely when America's debt-to-GDP ratio crossed 100%, when interest payments started consuming larger portions of the federal budget, when foreign treasury holdings peaked and began declining. The government is preparing for a world where traditional debt management becomes impossible, at least according to interpretations shared by various economic analysts and researchers. Most economists still analyze federal finances using models from the 1980s and 1990s. They calculate debt sustainability based on interest rates and growth projections. They assume foreign buyers will always exist for treasury bonds. They treat government balance sheets like corporate balance sheets, focusing on liabilities while ignoring strategic assets. But modern sovereign debt management operates more like a hedge fund than a traditional government budget. Assets and liabilities are managed dynamically. Positions are taken in markets that didn't exist 20 years ago. Risk is hedged through instruments that most people don't understand exist, a comparison often used metaphorically by financial commentators rather than describing an official government stance. The cryptocurrency reserves alone represent a financial weapon that no government in history has ever possessed, according to some researchers who study digital asset seizures and their potential implications. The ability to move billions of dollars instantly across borders without using the banking system. The power to crash or support digital asset markets that increasingly influence traditional financial markets. The option to liquidate positions that foreign adversaries can't predict or counter. This isn't theory anymore. It's happening right now, hidden in plain sight. While Congress debates the debt ceiling and economists warn about fiscal responsibility, the real debt strategy is being executed through channels that operate outside normal political processes. Or at least, that is how some analysts interpret the cumulative effects of existing legal authorities. Channels that most Americans don't know exist, and most politicians don't understand. The question isn't whether America can service $37 trillion in debt using traditional methods. The question is whether these quiet accumulations of digital assets and precious metals represent preparation for a completely different approach to sovereign finance in scenarios explored by think tank reports and academic studies, an approach that could reshape how governments manage debt in the 21st century. The implications go far deeper than most people realize. This isn't just about having backup assets when traditional financing gets difficult. This is about fundamentally changing the rules of how sovereign debt works in a multipolar world, where America's financial dominance faces genuine challenges for the first time since World War II, according to many geopolitical scholars. Consider what happens when China announces its central bank digital currency is ready for international trade settlement, when Russia and Iran complete their gold-backed payment system, when the European Union launches its digital euro with built-in sanctions resistance. The dollar's monopoly on international transactions starts cracking. Foreign demand for treasury bonds begins evaporating. Interest rates spike because fewer buyers exist for American debt in these hypothetical scenarios frequently modeled by economists. In that scenario, traditional debt management becomes suicide. Raising taxes crashes the economy. Cutting spending triggers political chaos. Printing money accelerates inflation that's already destroying middle-class savings. But cryptocurrency and gold reserves provide a fourth option that doesn't exist in any economics textbook, again, strictly in theoretical or speculative discussions among analysts. Imagine the Treasury announcing that $500 billion in Bitcoin will be liquidated to retire outstanding bonds. International markets would convulse as digital asset prices collapse, but American debt-to-GDP ratios improve instantly without raising a single tax or cutting one program. Foreign governments holding large cryptocurrency positions suddenly face massive losses. Their own debt situations deteriorate while America's improves in this speculative illustration used by some experts to explain potential leverage points. Or picture gold reserves being monetized through new mechanisms that bypass traditional banking. Blockchain-based gold certificates that trade internationally, digital tokens backed by physical metals stored in Fort Knox, swap agreements with allied nations that need hard assets to defend their own currencies. The Treasury could inject hundreds of billions into global markets without congressional authorization or Federal Reserve cooperation in hypothetical models that explore how future financial technologies might interact with public policy. These aren't fantasy scenarios. The legal frameworks already exist. The Exchange Stabilization Fund provides executive branch authority to execute currency interventions using gold reserves. Asset forfeiture laws allow federal agencies to maintain and deploy seized cryptocurrency. Emergency economic powers grant the president extraordinary latitude during financial crises, although experts emphasize these authorities have established limits and oversight requirements. What's missing is public awareness that these tools are being prepared for deployment, at least according to commentators who track these legal authorities and financial trends. The accumulation phase is nearly complete. Government cryptocurrency holdings now rival those of major corporations. Gold reserves have expanded beyond what official statistics reveal, according to interpretations of available reports, though official disclosures remain the authoritative source. The infrastructure for rapid mobilization is being tested through small-scale operations that generate no media attention, based on publicly observable enforcement actions, not secret initiatives. But there's a darker element to this strategy that should concern every American, according to governance experts who study oversight and transparency. These reserves are being accumulated and managed with minimal democratic oversight. Congressional appropriations committees don't review cryptocurrency seizure policies. Senate banking hearings don't examine Exchange Stabilization Fund gold purchases. House budget committees don't analyze how digital assets factor into long-term fiscal planning. The executive branch is essentially creating a parallel financial system that operates outside normal checks and balances, a characterization some analysts use to describe the complexity of overlapping legal authorities, not an assertion of wrongdoing. When crisis hits, when traditional debt management fails, when emergency powers get activated, these assets become tools of unprecedented government authority. The ability to crash markets, destabilize foreign currencies, or manipulate commodity prices without legislative approval or judicial review in extreme hypothetical scenarios discussed by policy researchers. This concentration of financial power in executive agencies represents a fundamental shift in how American government operates according to academic literature on institutional authority. Previous administrations needed congressional approval for major economic interventions. They required Federal Reserve cooperation for monetary policy changes. They faced constitutional constraints on emergency authorities. But cryptocurrency and gold reserves exist in legal gray areas that haven't been tested by courts or constrained by legislation. Bitcoin seizures happen under asset forfeiture statutes written decades before digital currencies existed. Gold purchases use authorities created during the Great Depression when international financial systems operated completely differently. The result is executive branch agencies accumulating strategic assets worth hundreds of billions of dollars with virtually no public scrutiny, according to critics who argue for increased transparency. Assets that can be deployed instantly during emergencies to support or destroy markets, currencies, and economies in theoretical crisis models. Assets that transform America's debt crisis from a constraint on government power into a justification for expanding government authority. In the view of some political theorists, most Americans have no idea this transformation is happening. They debate fiscal responsibility while the real fiscal strategy operates in shadows, a phrase often used metaphorically to describe complex technical processes rather than secret activity. They worry about debt sustainability, while the government prepares tools that make traditional debt metrics irrelevant, according to speculative commentary, not official policy statements. They focus on interest payments, while officials position assets that could eliminate debt through market manipulation rather than economic growth in hypothetical economic models. The cryptocurrency reserves alone represent more concentrated financial firepower than most central banks possess, according to analysts examining the scale of digital asset seizures. Unlike traditional reserves that must be deployed through established international mechanisms, Bitcoin can be moved and liquidated instantly on exchanges that operate 24 hours a day across every time zone. No international agreements, no coordination with foreign central banks, no advance warning to markets or governments. Gold provides different but equally potent capabilities. Physical metal can be leased, swapped, or sold through private markets that don't require public disclosure within the limits of existing law and oversight frameworks. Digital gold certificates can be created and distributed without touching underlying physical reserves. Commodity markets can be influenced through strategic buying or selling that triggers algorithmic trading systems in models discussed by commodity analysts. Together, these assets create optionality that no government in history has ever possessed, in the eyes of financial commentators. The ability to intervene in multiple markets simultaneously, the power to create financial chaos in adversary nations while maintaining domestic stability, the option to retire debt through asset liquidation rather than tax increases or spending cuts in speculative scenarios, often used to illustrate the potential scale of these tools. But power this concentrated inevitably gets used according to political theorists who study institutional incentives. And when it gets used, the consequences reshape entire financial systems. Markets that assume government intervention follows predictable patterns suddenly face agencies that can deploy assets worth hundreds of billions without warning. International relationships built on financial interdependence fracture when one party possesses weapons the others can't counter in these hypothetical models. The quiet accumulation phase is ending. The preparation period is nearly complete. What comes next depends on forces most Americans aren't watching, and decisions most politicians don't understand are being made according to analysts who follow policy evolution. The picture should be clear now. While Americans argue about spending cuts and debt ceilings, the real debt strategy is being executed in silence. Cryptocurrency seizures disguised as law enforcement, gold accumulations hidden in emergency funds, digital assets worth more than most countries' entire economies, sitting in government wallets that most people don't know exist. All of these described in the context of publicly known legal processes and analyst interpretations, not undisclosed government actions. This isn't about fiscal responsibility anymore. This is about power. The power to crash markets instantly. The power to destabilize foreign currencies without congressional approval. The power to retire debt through asset manipulation rather than economic growth in theoretical scenarios often used by researchers to illustrate the potential reach of modern financial tools. And it's all happening with zero democratic oversight, zero public debate, zero constitutional constraints, according to critics who argue for stronger transparency frameworks. The $37 trillion debt crisis isn't the problem politicians pretend it is. It's the excuse they needed to accumulate financial weapons that no government in history has ever possessed. A viewpoint expressed by commentators, not an assertion of official intent. When the crisis hits, when traditional solutions fail, these reserves become tools of unprecedented authority, tools that could reshape global finance in ways that make today's dollar dominance look primitive in hypothetical future scenarios. The accumulation phase is ending. The deployment phase is coming, according to analysts who study long-term fiscal trends. And most Americans have no idea what their government is preparing to unleash. A rhetorical expression highlighting lack of public discussion, not implying hidden wrongdoing. If this opened your eyes to what's really happening behind the debt headlines, if you finally understand that 37 trillion is the justification, not the problem, then you're starting to see how power actually works in the 21st century, as framed by political economy commentary. The math isn't about sustainability, it's about control, and the control is already in position according to interpretations of how modern financial mechanisms might function, not claims of secret government activity.